Most investors think financial freedom and maximum wealth are the same thing. Build enough wealth and freedom automatically follows. At least that's what everyone assumes. But what if those two goals are actually pulling in different directions? Imagine two investors. 20 years from now, investor A has built a real estate empire worth $8 million. Investor B owns a much smaller portfolio worth only $2 million. So here's the question. Which investor would you rather be? Most people immediately choose the $8 million portfolio. And honestly, that seems like the obvious answer. More money equals more freedom, right? Not necessarily. What if the investor with $2 million stopped working 10 years earlier? What if they have stronger monthly cash flow, less stress, and more control over their time? Today, we're breaking down one of the biggest trade-offs in investing: financial freedom versus maximum wealth. By the end of this video, one strategy will clearly win in net worth. The other will clearly win in freedom. And the surprising part is that most investors spend years chasing one while secretly wanting the benefits of the other.
Let's start with investor wealth. Investor wealth has one primary objective: build the biggest portfolio possible. Every extra dollar gets reinvested. Cash flow gets reinvested. Refinancing proceeds get reinvested. New opportunities are constantly pursued. The goal is simple: acquire more assets. Over time, the portfolio expands. 5 rentals become 10. 10 become 15. 15 become 25. Property values rise. Tenants help pay down loans. Appreciation compounds. On paper, the results look incredible. The portfolio value climbs into the millions. Net worth accelerates. And compared to most investors, investor wealth appears to be winning. But there is a cost. A larger portfolio creates more moving parts: more tenants, more maintenance, more vacancies, more financing decisions, more management, more complexity.
Debt-free properties can generate surprisingly powerful income. Income that can replace a paycheck. Income that can fund a lifestyle. Income that creates options. Now, let's compare risk. A highly leveraged portfolio can create tremendous wealth, but leverage cuts both ways. Vacancies matter more. Market declines matter more. Financing becomes more important. Investor freedom typically operates with a larger margin of safety, fewer obligations, lower fixed costs, less pressure. Then there's flexibility. Imagine both investors receive an unexpected opportunity. Take a year off. Travel, spend more time with family, reduce working hours. Who has more flexibility? The investor with the larger portfolio or the investor with stronger passive income? The answer isn't always obvious, and that's exactly why this debate exists. Because wealth and freedom are not identical goals. Sometimes they overlap, sometimes they don't. A younger investor with decades ahead of them may choose maximum wealth, more growth, more assets, more upside. An older investor approaching retirement may prioritize freedom instead. More income, less risk, more control over time. Neither choice is automatically correct. Neither choice is automatically wrong. The real mistake is assuming they are the same thing. Because most people don't actually want a larger net worth. They want what they believe a larger net worth will eventually provide: freedom, security, flexibility, time. And if those are the real goals, then the strategy should reflect them. So before making the next investing decision, ask a different question. Not how can I become wealthier, but what am I actually trying to buy with that wealth? Because once that answer becomes clear, the path forward usually becomes clear too. And that's the real difference between chasing maximum wealth and building financial freedom.
And perhaps most importantly, much of the portfolio's cash flow is constantly being redirected toward future growth. The wealth is real, but a large percentage of it remains trapped inside the machine. Now, let's look at investor freedom. Investor freedom has a different objective. Instead of maximizing portfolio size, the goal is maximizing personal freedom. Extra cash flow isn't used to buy more properties. It's used to reduce debt. Month after month, year after year. At first, this strategy looks boring. The portfolio barely changes. The property count remains almost the same. Nothing dramatic appears to happen. But underneath the surface, the numbers are changing. Mortgage balances shrink. Interest costs disappear. Risk declines. And eventually, something powerful happens. The properties become paid off. That's when the game changes. Because mortgage payments are usually the largest expense attached to a rental property. Remove that expense, and cash flow increases dramatically. The same tenants, the same rents, the same properties, but far more income stays with the owner.
If you found this useful, subscribe for more real estate investing frameworks and financial freedom strategies. And remember, the best investment strategy isn't always the one that makes the most money. It's the one that gets you where you want to go.